Starbucks stock is currently trading at 89.75 USD, which marks an impressive intraday surge of plus 4.54 or 5.33% today, Friday, December 19, 2025. This sudden burst of green on the charts might look like a simple relief rally to the casual observer, but for those of us tracking the deeper movements of the consumer discretionary sector, there is a far more complex story unfolding beneath the surface. While the general market expectation is that Starbucks has finally found its footing under the new leadership and the massive restructuring efforts, the reality is that the company is currently navigating one of the most difficult operational pivots in its 50-year history. This gap between the public narrative and the hard data is where the most significant investment opportunities usually hide. When you look at your Fidelity mobile app or check the latest updates on Interactive Brokers, seeing a 5% jump in a single session for a titan like Starbucks is a signal that institutional money is likely repositioning. The market is betting on a very specific outcome right now, that the Back to Starbucks initiative is finally translating from a PowerPoint presentation into actual store-level profitability. However, the friction here is real. We are seeing a massive tug-of-war between rising labor costs and the aggressive implementation of new technology designed to speed up the mobile ordering process. If you're using Robinhood stock trading to play these daily swings, you might feel like the momentum is purely positive, but we have to look at the volume. Today's volume is significantly higher than the 30-day average, suggesting that some of the largest players in the individual brokerage space are deciding that sub-$90 is the floor. The standard belief among retail investors is that Starbucks is an invincible dividend king that provides a safe haven during periods of economic uncertainty. People assume that because everyone needs their caffeine fix, the revenue is guaranteed. But the reality we are seeing in the fourth quarter reports of 2025 shows a brand that is desperately trying to protect its premium identity while fighting off hyper-efficient competitors. In China, which remains the secondary engine for Starbucks growth, the pressure from Luckin Coffee has become almost unbearable. Luckin isn't just selling coffee, they're selling a digital-first, low-overhead pickup model that makes the traditional Starbucks third-place concept look expensive and slow. This is why we are seeing Starbucks shift its strategy toward more pickup-only locations in high-traffic urban centers, effectively admitting that the era of sitting in a plush chair for 3 hours with a single latte might be coming to an end in certain markets. If you are managing your own portfolio through Schwab Intelligent Portfolios or looking for investment help to diversify, you have to weigh these structural changes carefully. The company recently announced it would close over 600 underperforming stores primarily in North America to focus on uplifting the remaining 10,000. This is a massive capital expenditure. They're essentially tearing the kitchen out of the house while the family is still living in it. This creates a fascinating tension for the stock price. Usually, store closures are seen as a sign of weakness, but the market is rewarding Starbucks today because these closures represent a move toward higher margins and better efficiency. They are choosing quality over quantity, and for a company with over 40,000 locations globally, that is a brave but necessary call. Looking at the Interactive Brokers platform data, the institutional ownership remains high, with giants like Vanguard and Capital Research Global Investors actually increasing their stakes in the third and fourth quarters of 2025. This tells us that the smart money isn't scared of the restructuring, they're betting on the long-term yield. Speaking of yield, the dividend currently sits at around 2.9%, which is quite healthy compared to the broader consumer discretionary average. For those who invest online through platforms like SoFi Invest, this yield acts as a safety net, but it also raises questions about the payout ratio, which has climbed as earnings per share took a hit from the restructuring costs. Let's talk about the actual trading mechanics for a second. If you look at the technical indicators on the Fidelity trading platform, SBUX has been struggling to stay above its 200-day simple moving average for much of the latter half of the year. Today's move to 89.75 puts it right back in the fight for a bullish breakout. If it can close the week above 90, we might see a sustained run toward the $100 mark. But if this is just a short-lived reaction to a favorable macro headline, we could see a retreat to the $85 support level. For those doing self-investing, these technical levels are crucial because they dictate where the algorithmic selling pressure will kick in. At this point, I want to hear from you. Comment below how many shares of Starbucks stock you currently hold and whether you think the new pickup-only store format will help or hurt the brand's premium image in the long run. Your feedback helps us gauge the sentiment of the actual people holding the stock, not just the analysts on Wall Street. Now, to understand why the stock is moving this way, we have to revisit the core business model. Starbucks isn't just a coffee shop, it's a massive logistics and real estate company. Roughly 82% of their revenue comes from company-operated stores. This gives them total control over the customer experience, but it also means they bear the full weight of inflation, rising wages, and local regulations. When the cost of milk or coffee beans goes up, Starbucks can't just pass that on to a franchisee, they feel it immediately on their bottom line. This is a double-edged sword. In a growing economy, they capture all the upside. In a stagnant or inflationary environment, their margins get squeezed from both sides. This is why the Fidelity Wealth Management teams often look at Starbucks as a proxy for the American consumer's health. If people are willing to pay $7 for a specialized cold brew, the economy is doing just fine. The recent movement we are seeing today is also likely a reaction to the anticipation of the upcoming Investor Day in late January 2026. The expectation is that the CEO will provide a very clear roadmap for how the company will return to double-digit earnings growth. The expectation is high, but the reality is that they are still dealing with a 1% decline in transaction volume in the U.S. That is the number that keeps analysts up at night. You can raise prices all you want, and Starbucks has, to keep revenue flat or slightly up, but if fewer people are walking through the door, your brand is losing its cultural gravity. The Back to Starbucks plan is supposed to fix this by making the stores feel more like community hubs again, while simultaneously making the mobile app experience less chaotic for the baristas. For those of you using online investing tools like SoFi Active Investing or the Robinhood app, you've probably noticed that the rewards program has also undergone some changes. The company has over 34 million active rewards members in the U.S. alone. This is an incredible data moat. They know exactly what you want, when you want it, and what price will trigger a purchase. This data is what powers their intelligent portfolio of promotions. However, there is a risk of discount fatigue. If you have to offer a buy one get one free deal every Tuesday just to keep the traffic up, you're effectively training your customers to never pay full price. This is the delicate balance management is trying to strike right now. When we compare Starbucks to its peers on the Interactive Brokers stock charts, we see a company that is valued at a much higher price-to-earnings ratio than many of its fast food competitors. This is because the market still views Starbucks as a luxury brand, not just a commodity provider. But as the competition heats up from places like Dutch Bros or even the McCafe line at McDonald's, that premium halo is being tested. If you are looking at investing sites for a direct comparison, you'll see that Dutch Bros is growing much faster in terms of store count, while McDonald's is leveraging its massive scale to offer similar coffee products at a much lower price point. Starbucks has to prove that the experience is still worth the extra $3. The reality of the situation is that Starbucks is in a transition phase. They are cutting the fat, closing weak stores, and reinvesting in the green apron partners, the employees. They've spent over $500 million on labor and store operations recently. This is a massive bet that a happier, better-equipped workforce will lead to faster service and more satisfied customers. If this works, the stock at $89.75 USD will look like a steal a year from now. If it doesn't, and transaction volumes continue to slide, we could see the stock retest those yearly lows in the mid-70s. In the final analysis, the central insight here is that the market is currently buying the turnaround story, but the operational data is still a bit messy. The expectation of a quick recovery is driving today's 5.33% gain, but the reality of a global restructuring means there will likely be more volatility ahead.
We saw the operating margins contract significantly this year due to these one-time restructuring costs, which is why the GAAP earnings looked so dismal. But if you look at the non-GAAP numbers, the ones that strip out the noise of the store closures, the business is actually quite resilient. Institutional investors are clearly looking past the current mess and focusing on what the company will look like in fiscal 2026 and 2027. They see a leaner, more efficient company that has successfully integrated its digital and physical presence. For the individual investor using Fidelity Brokerage or SoFi Investing, the question is whether you have the patience to sit through the remaining quarters of this restructuring. The Back to Starbucks plan isn't a quick fix, it's a deep tissue massage for a company that had grown a bit too stiff and corporate. To wrap things up, Starbucks is currently a battleground stock. Today's movement is a clear win for the bulls, driven by the belief that the worst